Every empire swears its money is safe. Every government insists its promises will last. And yet, again and again, history proves them wrong. In 1971, the United States did something that should have killed the dollar. It walked away from gold. For decades, foreign governments had been told that every $35 they held could be turned into 1 ounce of American gold, sitting in vaults in Fort Knox or beneath the Federal Reserve. Those green pieces of paper were supposed to be claims on something tangible, something ancient, something no central bank could print. Then, almost overnight, that promise vanished. President Richard Nixon told the world the United States would no longer redeem dollars for gold. The gold window was closed. The anchor that held the post-World War II monetary system in place was cut loose. On paper, the dollar became just another fiat currency backed by confidence and nothing else. Under normal circumstances, that should have been the beginning of the end. Why would Germany, Japan, or Saudi Arabia continue to hold vast piles of paper that could no longer be swapped for anything real? Why would central banks trust a government that had just changed the rules to avoid paying its debts in gold? And yet the opposite happened. In the decades that followed, the dollar did not fade into irrelevance. It did not suffer the fate of the British pound after World War I. It did not collapse like the French franc of the 1920s or the German mark of the early 1920s. Instead, it became even more dominant. Countries that could have demanded payment in anything, gold, Swiss francs, Deutsche Marks, chose and in some cases were nudged to insist on dollars. Every factory in Europe, every power plant in Asia, every airline in Africa needed dollars before they could even turn on the lights or fuel a plane. So the question is simple and unsettling. If gold no longer backed the dollar, what did? This is the gold dossier, where money, power, and history collide, and nothing is ever as simple as it looks. You're told the dollar's dominance is a natural product of market confidence, of America's dynamic economy, deep capital markets, and the rule of law. There's truth in that story, but not the whole truth. What the textbooks rarely say is that in the 1970s, a quiet deal replaced gold with something far more political. A deal that turned oil into the new gold, a deal that swapped metal in vaults for barrels under sand, a deal that made the world's thirst for energy the real collateral behind the dollar. To see how that happened, you have to go back to the promise that came before the break. After World War II, the Bretton Woods system set the rules. The dollar would be the central currency of the world, and the dollar would be as good as gold. Foreign governments and central banks could take their surplus dollars and redeem them at a fixed rate, $35 for 1 ounce of gold. Ordinary citizens couldn't do this, but their governments could. That was the foundation of trust. The United States, however, realized it was holding a unique position. It controlled the printing press for the currency everyone needed, and it held the largest gold reserves. So it did what empires always eventually do. It pushed the privilege too far. Wars in Korea and Vietnam, the arms race against the Soviet Union, the expansion of the welfare state at home, guns abroad and butter at home, all funded with dollars instead of unpopular taxes. It was easier to issue IOUs than to tell voters no. The United States began exporting more paper than it had gold to cover. By the 1960s, the arithmetic was brutal. Foreign central banks counted the dollars they held. They counted the gold the United States admitted to owning. They realized the uncomfortable truth. There were far more paper claims than metal in the vaults. Some countries decided not to wait around to see who would be left holding the bag. France, under President Charles de Gaulle, famously sent ships loaded with dollars to New York and demanded gold in return. Quietly but steadily, gold bars left American vaults and sailed across the Atlantic. Other nations followed. Confidence in the promise of convertibility began to erode. This wasn't speculation. It wasn't a conspiracy. It was math. If everyone tried to cash in at once, the system would fail. The United States could either watch its gold disappear or rewrite the rules. On August 15, 1971, Nixon went on television and did exactly that. He suspended the convertibility of the dollar into gold. No more swaps, no more $35 per ounce. The world now held a currency backed by nothing but the word of a government that had just broken its biggest monetary promise. In theory, that should have triggered a run from the dollar. Central banks could have diversified into other currencies, hoarded more gold, or tried to build regional alternatives. For a moment, the system wobbled. Currencies were revalued, capital flows surged, and inflation began to rise. But in another corner of the world, the oil age was preparing a different lifeline for the dollar. In 1973, a new shock hit. This time, it was not gold, it was oil. Arab oil producers, furious over Western support for Israel during the Yom Kippur War, announced an embargo. Shipments to the United States and several European countries were sharply reduced. Tankers slowed. Production cuts were announced. Prices spiked. Gasoline lines formed in the United States. Cars stretched for blocks, waiting for fuel. In Europe and Japan, energy costs ripped through the economy. Inflation surged. The price of oil roughly quadrupled in a short period. To most people, this looked like a simple geopolitical story. Angry producers, vulnerable consumers, and a weaponized commodity. But underneath the drama, a deeper transformation was taking shape. Oil exporters were suddenly drowning in dollars, because even after the gold link was broken, almost all oil contracts worldwide were still denominated in dollars. Every barrel of crude leaving the Persian Gulf, every shipment heading to Europe, Asia, or America, priced in the same green paper that had just lost its tie to gold. As the price of that barrel surged, so did the inflow of dollars to the treasuries of Saudi Arabia, Kuwait, and other OPEC members. A torrent of dollars poured into small, often sparsely populated countries with limited capacity to absorb the money domestically. This created a strange imbalance. Oil producers had too many dollars and not enough safe places to put them. They didn't want warehouses of physical cash. They wanted assets, security, influence, somewhere to park their wealth where it could earn interest and remain, in theory, protected. The United States, on the other hand, had the mirror image problem. It had deficits. It had rising inflation. It had a currency no longer tied to gold. It needed the rest of the world to keep trusting those pieces of paper. It needed buyers for its government bonds. It needed a reason, an unavoidable, structural reason, for other countries to keep demanding dollars even without gold. The solution was simple in concept and complex in consequence. Turn oil itself into the new anchor. Make access to energy contingent on access to dollars. In the mid-1970s, American officials and Saudi leaders quietly struck an understanding that did exactly that. It was not announced with fanfare. There was no grand doctrine named after it. It appeared as a series of agreements, visits, weapons deals, and financial arrangements that, taken together, formed a new system. Saudi Arabia would price its oil exclusively in US dollars. As the world's swing producer and most influential member of OPEC, that choice would effectively set the standard for global trade in oil. Other producers would follow, because the biggest player had set the rules. In return, the United States would provide military protection for the Saudi kingdom, sell it advanced weapons, and shield it diplomatically. It would also open its financial markets to the flood of oil revenue, allowing Saudi and other Gulf states to recycle their surplus dollars into U.S. Treasury bonds, stocks, real estate, and other assets. Oil for dollars, dollars for weapons and protection. And the loop would feed itself. This is what people mean when they talk about petrodollars. Not a new currency, not a formal treaty, but a system. Oil priced in dollars, dollars reinvested into U.S. financial markets, and American power underwriting the security of key oil states. Now imagine the practical impact. A factory in West Germany wants to keep its machines running. It needs oil. It cannot pay Saudi Arabia in marks. It must get dollars. A power utility in Japan needs fuel to generate electricity. It cannot ship yen to Kuwait. It must get dollars. An airline in Brazil needs jet fuel. It cannot settle the bill in real. It must get dollars. So these countries face a simple choice: export goods and services to dollar-rich markets, especially the United States, and earn dollars through trade, or borrow dollars from international banks and institutions, going into debt in a currency they do not control. In both cases, the dollar sits at the center. It is not backed by gold anymore. It is backed by the world's need for energy, and by the political and military arrangements that keep that energy priced in dollars. Gold, in the old system, restrained the issuer. If the United States printed too many dollars, other countries could show up and demand gold, and the metal would leave. The pain was felt in Washington. Oil, in the new system, disciplined the users. If other countries wanted oil, they needed dollars, and if they needed dollars, they had to export more, borrow more, or hold more U.S. assets. The strain moved outward, away from the issuer and onto the rest of the world. The petrodollar system turned the world's thirst for energy into a constant source of demand for U.S. financial assets. Oil exporters sold crude for dollars, then used those dollars to buy U.S. government bonds and other instruments. The dollars made a round trip from American consumers and companies to oil producers and back into American debt markets. It was a kind of monetary recycling plant, quietly operating behind headlines about inflation, interest rates, and geopolitics. Where did gold go in all of this? Officially, it was demoted. In 1971, it lost its fixed link to the dollar. In 1973, major currencies began to float more freely against one another. Economists declared that gold had been demonetized, reduced to just another commodity. But gold never got the memo. Central banks kept large reserves. Some sold, some bought, but few abandoned it entirely. Investors watched it carefully. And in the 1970s, as inflation rose and trust in paper promises weakened, the price of gold exploded. It wasn't acting like a useless relic. It was acting like a barometer of confidence. While the petrodollar system quietly took shape, gold played a different role. No longer the official foundation of the monetary order, it became an unofficial judge. As policymakers expanded the money supply and oil shocks rippled through the economy, gold prices signaled how much faith the market still had in paper. For ordinary people, the message was harsh. Their wages, salaries, and savings sat in currencies being eroded by inflation and financial engineering. A paycheck denominated in dollars, pounds, or lira could buy less each year. The terms of the game had changed, but most people were never told the rules. For those who understood, the strategy adjusted. You didn't have to hold dollars forever, but you had to understand their role. Dollars were the ticket you needed to play at the global table, especially to buy energy. The trick was knowing when to trade those tickets for something real. Land, productive businesses, resources, and yes, gold before the next round of monetary experiments. The quiet deal of the 1970s created winners and losers. On the winning side, the United States retained what some European officials once called its exorbitant privilege, the ability to finance its deficits in its own currency at relatively low cost because the rest of the world had to hold that currency to keep the lights on. It could run trade deficits for decades, importing more than it exported, and pay for it with promises that other countries willingly accepted. Oil-rich monarchies in the Gulf converted underground reservoirs into skyscrapers, sovereign wealth funds, and diplomatic clout. Their surpluses flowed into Western banks, Western weapon systems, Western universities, and Western real estate. Their relationship with Washington bought them protection and prestige. Wall Street sat in the middle, turning petrodollars into loans, bonds, and complex financial products. Every barrel of oil sold in dollars meant more flows through the U.S. banking system, more instruments to create, more leverage to build, more deals to arrange. On the losing side, many developing nations borrowed heavily in dollars during the 1970s and early 1980s. Banks in New York and London, awash in petrodollars, were eager to lend. Governments in Latin America, Africa, and parts of Asia took on dollar debt, often assuming that growth and stable interest rates would make it manageable. Then interest rates rose. The global economy slowed. The bill came due. Countries that could not print dollars found themselves in crisis. Their currencies collapsed against the dollar, making their debts more expensive in local terms. Inflation surged. Living standards fell. International institutions stepped in with rescue packages tied to harsh conditions: spending cuts, austerity, privatization, and deep restructuring. The polite term for this was structural adjustment. The reality on the ground was simple. Ordinary citizens bore the costs of a system whose rules they never voted on. When you zoom out, the story of petrodollars versus gold is not really about choosing one or the other. It is about how power adapts when an old system breaks down. By 1971, the gold-dollar link was unsustainable. The United States had issued more promises than it could honor in metal. The choice was clear: shrink its ambitions and live within its gold-backed means, or change the system so the constraints disappeared. It chose to change the system. The world moved from dollars are as good as gold to dollars are the key to oil. Gold was physical discipline. Oil was strategic leverage. Gold punished the issuer for excess. Oil forced the users to comply. One regime restrained the center. The next restrained the periphery. That is the quiet genius and quiet violence of the 1970s deal. Today, you hear more talk about de-dollarization, about countries seeking to trade outside the U.S. currency, about central banks adding gold to their reserves again. You see news of oil deals priced in other currencies, barter arrangements, and new payment systems designed to bypass traditional channels. Does this mean the petrodollar system is dead? No, not yet. Systems this large rarely die suddenly. They erode, crack at the edges, and reconfigure over time. Oil is still predominantly priced in dollars. Global finance is still centered around U.S. markets. Habit, network effects, and fear still keep the old arrangements in place. But the deeper lesson is not to bet your life on the permanence of any single system. Monetary orders are not laws of physics. They are deals, sometimes written, often unwritten, between governments, banks, corporations, and resource powers. They last as long as they serve the interests of their key players. Then they evolve or end. Gold was one such deal. Petrodollars were another. There will be others. So the question isn't whether the dollar is safe. The better questions are, what truly backs it right now? Whose interests are protected by that backing? And what happens when those interests shift? Because they always do. Politicians will keep talking about the strength of the dollar. They'll invoke stability, confidence, and leadership. They will rarely mention the moment in the 1970s when oil quietly took gold's place as the backbone of global demand for dollars. They will almost never remind you that the systems supporting a currency are always a mixture of force, habit, and convenience, not just economic theory. Gold still sits in vaults, silent and patient, outlasting slogans and speeches. Oil still flows through pipelines and onto tankers, essential to any society that has not yet fully escaped fossil fuels. Dollars still flash across trading screens, summoned and erased with central bank keystrokes. The balance between these three, paper promises, energy flows, and tangible value, defines the current era. When that balance tilts, whether through war, energy transition, technological shifts, or political rupture, The world will once again discover what really backs its money. Those who understand the last deal are always better prepared for the next one. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.